Good afternoon. I'm Phil Flakes, co-founder at Succession Link, and I will be the moderator for today's webinar. I would like to thank you all for attending, and I certainly hope that you find the content in today's webinar to be valuable. Three quick notes from a housekeeping standpoint to mention. First, we are recording this webinar and will distribute to all attendees, hopefully before the end of the week. Second, we have a few handouts that we will be referencing throughout the presentation. Those reference materials can be found on the right-hand side of your screen for you to download during the presentation, and they will also be distributed by email with the recording, again, before the end of the week. Third point, for those of you who ask questions on the registration form, thanks for submitting those questions, and we will look to address as many of those as we possibly can throughout the presentation. So based on the registrations, there looks to be a pretty good divide between active annual subscribers, folks who may still be considering joining our community, and those that are brand new to Succession Link. So for the benefit of anyone brand new to our community, Succession Link was launched in 2013 and really as an extension of a successful transition consulting firm called StarPoint Consulting Group. StarPoint focused on helping financial advisors throughout any transition that they may be considering within their business, whether that was simply changing from one firm to another, starting their own firm, or structuring succession and continuity partnerships. Since 2009, StarPoint has helped transition nearly 200 financial advisory practices with collectively over $6 billion in total client assets. And so with the same executive team, we launched Succession Link in 2013. And today, Succession Link is the leading networking and communication platform, connecting financial advisors who are interested in buying, selling, or merging financial advisory practices, and also practices in search of succession and continuity partnerships. So just last month, we passed over 4,000 registered users. And to give you some sense of the members within the community, we have roughly 85% of our users coming from the independent channels, which includes advisors with an independent broker-dealer affiliation, registered investment advisory firms, and the independent advisory representatives of those registered investment advisory firms. The remaining 15% are coming from a wirehouse or a captive advisor environment. And so at Succession Link, we place a very high value and focus on creating tools, resources, and educational content to really promote and encourage online introductions of like-minded financial services professionals. An example of an educational resource being the webinar that you are joining here today, titled Financing Options for Practice Acquisitions, Learn the Banker's Mentality. This webinar is packed with a great deal of information on what banks are really looking for, the process to getting financing, and some best practices to think about along the way. I have the pleasure of introducing John Pierce, who is the Senior Vice President of National Accounts with Advisor Loans. Advisor Loans offers business and personal financing solutions exclusively to financial advisors. They are truly an advisor's advocate and look to be the single lending resource throughout a financial advisor's entire career. They are managed by financial services and banking insiders and are intimately familiar with advisor cash flow-based business models, growth goals, and nuances. For those reasons, they are a preferred financing partner to the Succession Link platform. And with us again today, we have John Pierce. And in John Pierce's role as Senior Vice President of National Accounts, he maintains national account relationships with broker-dealers, insurance firms, associations, and national alliances. By way of background, John spent 14 years at Merrill Lynch as a producer, district sales manager, resident vice president, and complex director in Philadelphia. He then went on to spend 6 years at Ameriprise, primarily leading the recruiting efforts in the W-2 channel for Ameriprise. He's the author of the book Sell More and Sleep at Night, which focuses on developing relationships with emotional intelligence to increase sales. Outside of all this success that he's enjoyed within the wealth management industry, what is equally impressive about John is he's a 6-time Ironman. So thank you, John, for joining us today, and welcome.
Thank you, Phil. It's great to be here, and thank you to the Succession Link community. It has been awesome working with all of you, helping you to find different financing solutions. And as Phil said, Advisor Loans was set up specifically to cater to your needs, and we are the voice for we're the advocate and the voice for the advisor to multiple financial institutions. So I'm really excited about the webinar today, Phil, and thanks for having us.
Absolutely. So I'll get right to it. John, how should a financial advisor think about banking and the finance industry?
That's a great question, Phil. So just to understand, to level set what's going on in the industry, even though we're expecting interest rates to rise in the near future, banks are truly flush with cash. They have some significant capital to lend out to financial advisors who are looking for working capital or are looking for capital to purchase practices, whether in total or partial. So the good news is there's lots of money out there. The issue that many advisors face when they go to banks is that most banks don't understand cash flow-based businesses. As a financial advisor in the independent space, for the most part, you have an incredibly valuable asset. You are the one percenters. Your business has dramatic value. Unfortunately, the business doesn't have a lot of collateral. So many banks are scared to loan to financial advisors because it is cash flow-based business and there's very limited collateral. The good news is we've helped to solve that with our partners at Succession Link. We work with a series of banks that have cash and want to lend to cash flow-based businesses. That they're looking to provide lending for working capital, for lines of credit, and for capital to purchase practices. So multi-pronged solutions for the financial advisor in the independent space. Most loans, Phil, are 3, 5, or 7 years, and sometimes they can be 10 years. We'll get into the SBA in a little bit. SBA loans tend to be 10 years, and these 3, 5, 7, and 10-year loans can be completely variable. Banks prefer variable. They can be fixed, and fixed rates tend to be higher, or they can be hybrid. We do a lot of hybrid loans where we lock in the first 2 years, and then the last 3 or 4 float. Banks do require a lot of information, though. So banks are typically looking for 3 years worth of your tax returns as the purchaser of a practice. They're looking for 3 years of business metrics, not only for your current business, but also for the business you're going to purchase. And they are also going to be looking at your credit score. Banks tend to like to have advisors that have a credit score over 700, and they will check broker check. So the banks certainly require a lot of information, but that's an overview, Phil, just of kind of understanding where we are with the banking industry right now.
And I appreciate that response, John, especially the points in regards to the information that you guys need to collect. Here at Succession Link, through the registration process, we ask our audience for quite a bit of information. And from time to time, we get some pushback on getting accurate historical numbers and financials. Could you talk a bit more about why that information is needed and the importance from your perspective?
Sure. And for everyone on the call, this is not a Succession Link issue. It truly is the banking industry and what they need. And as one of Phil's teammates, Q, pointed out to me early in our process of setting up this webinar, you need to get your house in order. And so by working with Succession Link and providing them with the information they need early in the process, you're getting your house in order, and it's going to allow us to get you your loan quicker. So we'll talk about what we do, but we typically have to package all this up, and then we shop it to multiple lenders and have them compete for the business. So please don't think that Succession Link is being intrusive. It's truly the information that our banking partners need to put a package together and to get to yes. Our job as an advocate for the financial advisor at Advisor Loans is to get to yes, and that means, unfortunately, a lot of information gathered in the beginning.
Great.
Is that helpful?
It certainly is. And one of the things I heard you mention in there as you go through the process is getting to the yes quicker, or getting through the process quickly. When you see this process stall, what are some of the reasons for the process kind of slowing down or stalling?
Yeah, another really good question, Phil. Thank you for asking that. So there's 2 key areas that we see these loans stall. One has to do with document preparation. One has to do with delegation. So I understand that as a financial advisor, you're incredibly busy. You're hunting, you're gathering assets, you're running a business. And you may delegate away the document gathering process. That's okay. You should only have one person that's gathering all the information, not multiple people. Sometimes when you have multiple people, too many cooks in the kitchen. The other thing with delegation is it's okay to delegate and have one key person, your COO or someone at the firm, gather the information. You need to make sure you check in on a consistent basis to ensure that the information is actually being gathered. Because what happens is, as a financial advisor, you delegate it away and assume everything is done. But what happens is that we'll come back to you and say, well, we're missing these 3 pieces of information. And that's when it really gets stalled. Because when we put the package together to buy a practice, Phil, we can issue a pre-qualification for an actual sale very quickly, because we know what the underwriting standards are for each of our banking partners. So we have 12 different SBA lenders, and we have 14 other lenders that we use for other types of lending. And so we know what their underwriting criteria are, so we can get you a letter of intent or a pre-qual pretty darn quick, but it's only once all the information is put together, the package is complete. So it's important, as the owner of the business, buying a business, that you control the process and have regular touch bases with your person you delegate to. Also, it's really important to audit the business metrics. A lot of times, exogenous events may occur. So you dropped a really big ticket at the end of a quarter, and your production spiked 200,000 in GDC. Well, the banks are going to want to know what kind of events happened throughout the business cycle when you get to valuations. And so the way we work, Phil, at Advisor Loans is we send out a secure link. In that link, it has a list of all the documents that you need to gather up. Once that's done, we then complete the package and then send it to multiple lenders and have them compete for the business and bid in the business. So, the reason the process slows is the advisor thinks everything's got a green light and we're in good shape, but we're not, behind the scenes, we're not getting the information. So that's kind of, that's 2 things that happen: delegation, and just assuming that it's done. The other one is you don't really have an agreement in place. So you think you have an agreement in place with an advisor, and we'll talk about the process in a little bit, but you really don't. If you don't have a written agreement, or at least you've gone through verbally key terms of what you're doing, it's too soon in the process to start gathering documents. So those are a couple of the reasons that we fumble with getting to yes, Phil.
Okay. To switch gears a bit, we've been told that there's a growing focus on tax liens by the regulators. Can you give us a little bit of color on what Advisor Loans is seeing?
Yes. It is a scary environment out there. FINRA is investing tens of millions of dollars looking for tax liens of financial advisors and, quite frankly, anyone who's actually licensed. And they made up that tens of millions of dollars by finding firms and finding individual FAs. There's a fee schedule that they find per day with regarding tax liens. So I have a couple safety tips, Phil. The first safety tip is please don't hide your head in the sand. If you have a tax lien, the lien needs to be disclosed. FINRA requires disclosure of a tax lien within 30 days of the lien being filed. So there's a fallacy out there that if you paid your lien off, you don't have to disclose it. That's incorrect. Even if the lien is paid off, you need to disclose it. Secondly, even if the lien is paid off and it's released, it still needs to be removed from the public record for your credit score to get the full benefit. So about 30% of the clients that we talk to, Phil, have a tax lien issue or a credit issue. A second safety tip, if it hasn't happened to your firm yet, it's going to happen to your firm. Firms are conducting external lien sweeps on all licensed people. They want to find out if their FAs or registered professionals have a tax lien. They want to get it fixed before FINRA finds it first, and not only finds them, but it could put people out of business. So my first safety tip was don't hide your head in the sand. My second safety tip is please, if you have an issue with the tax lien, let's address it. What happened was we didn't realize this was that big of a deal until we started seeing all this FINRA action. And so we started a tax and regulatory division. It's run by a gentleman named Doc Kennedy. Doc is our managing attorney, and Doc has a team of attorneys that work with our advisors to help them not only with tax liens but with credit issues. So you can check out advisorloans.com, and in there you'll see a tax guide that'll walk you through what we do. You can call Doc, you can email Doc or his team, and they'll get back to you. But please, tax liens are a big deal, and it's becoming a bigger deal with FINRA. It's also becoming a revenue generator that'll cost you and your firm if you haven't disclosed it. From a credit perspective, most banks are looking for credit scores over 700, 680, 700-ish. You really have to make sure that there are no ongoing or open regulatory actions. Banks won't lend if there's an open item. I'm not saying you have to have a perfectly clear regulatory record, but what I'm saying is banks will not loan to you if there's an ongoing investigation or if there's an open action against you. So that has to be cleared up before we go to the banks. And then the other thing that banks look to, Phil, is debt flow coverage. It is a cash flow-based business, and having the ability to repay the debt is the only thing the bank really cares about. And so they do look at debt flow coverage when you're thinking about credit and getting loans from any bank. But I hope that helps on the lien issue, Phil.
No, it certainly does, and thanks for that answer there. If I could switch gears to valuation, there seems to be a lot of conflicting information about business valuations. I think any trade publication you pick up, you can always read an article about, valuation methodologies. Could you first give us a sense of when you should get a valuation if you're an advisor, and then how does Advisor Loans approach valuations?
Yeah, this is a good topic, Phil. Great topic. So the first thing is that when you're working with Succession Link, please provide all the information that Phil and the team needs. Providing that information is really helpful for the start of the process, but also finishing the process. The biggest gap I see with regard to valuation is advisors going to get a valuation of a practice before you actually have a sale agreement in place. And I alluded to that earlier. I'm not saying you have to have the final legal sale document executed, but you really need to make sure that you have a framework agreement with the seller and the buyer. The reason I say that is we see a lot of advisors that will go out and get a valuation too soon in the process, and then when they go to actually execute an agreement to actually do the transaction, they disagree on different points. There's a lot of different things they can disagree on. So what I would say is Phil, is get the information first and then get the valuation. As I mentioned earlier, Q, one of your colleagues, talks about getting your house in order. It's important to have your house in order from a metrics perspective and a data perspective before you get a valuation. Once you have that purchase agreement, you can start the additional document gathering and preparation that we would want from Advisor Loans, and then you get an external valuation. So your friends at Succession Link and clearly at Advisor Loans, we have plenty of people that can provide an array of external valuations. There's some really good people out there in the industry, and Succession Link and Advisor Loans have discounted agreements with external firms so that you can get that valuation. Banks do require some things to do a loan, so they're going to need a valuation that is reasonable, and the cash flow of your business combined will be able to pay the loan off. They also want to make sure that there's no unreasonable deals out there. Sometimes when people get a valuation too soon, they think their business is worth 6x, and the bank will say, whoa, we can't do 6x, that's crazy. But so the rule of thumb on valuations is that it's about 80 basis points to 100 basis points for non-recurring revenue, and it's called 2.0 to the mid-2s recurring revenue, and the numbers can go higher or lower depending on the actual mix of the business, if there's any kind of major events that happen that increase the production. But there's but that's general rule of thumb. And again, banks want to make sure the valuation is fair to the buyer, to the seller, and to the bank. But most importantly, price is not the only thing that matters. I think too often when you get into a valuation, you want to get the last nickel out of the deal, and I see a lot of deals falling apart for the wrong reasons. Price is critical. I get it. But more importantly is when you sell your business, well, that FA or that team or that firm, are they going to take care of your clients the way you take care of them? Are they a really good cultural fit based on what you and your clients have been through the last 15, 20 years? Does the firm that is buying your business, they have a compatible investment philosophy, right? I mean, I've seen deals fall apart where you have a firm that has a view that every client should have X percent, in whatever, non-traded REITs or BDCs or whatever, and it's just not a compatible investment philosophy. You don't want to sell your business to someone that doesn't have a compatible business philosophy. And finally, you don't want to sell your business if it's a service model that's not going to work with your clients. Because remember, you typically don't get 100% of your money up front. You get it over a couple of years. You get a big chunk up front, but you don't get it all up front, and you want to make sure your clients are retained. Most sale agreements have a clause in there that you need to retain 80% of the assets for the sale price to remain as is. So I know price is really, really, really important. Please, when you're evaluating somebody's going to purchase your practice, it's really the relationship stuff really matters. Will they take care of your clients? Is it a good fit from a cultural perspective? Does the investment philosophy make sense to you and it will make sense to your clients? And then finally, is there a service model you're going to feel comfortable walking away from? So, Phil, that was a little long-winded. I apologize, but don't get the valuation early. Get your house in order, and then make sure you look at the intangibles prior to getting the valuation of who's going to be buying that practice.
Thanks for that, and we certainly echo your sentiments here at Succession Link as far as focusing more on the who versus the how much, especially at the beginning of this process. So can you talk a little bit about the number of banking relationships that you have over at Advisor Loans and some of the reasons why you have so many?
Sure. That's an awesome question. So Advisor Loans was started. We're all advisors. We've been either in the banking industry or we've been advisors, and we've led at large firms. And there was a dramatic need in the practice acquisition market for some competition. And so when I was a financial advisor at Merrill Lynch, I didn't buy one mutual fund for everybody. I didn't buy one mutual fund family for everybody. And our view as the advocate of the financial advisor, and even if you don't work with us and we get you a better deal somewhere else, we're happy. We want you to get the best deal from a financing perspective. So our view is you shouldn't be held captive to one lender. And so we have 14 different banks that we use for SBA lending, which we'll talk about if we have time in a little bit, because we want them to compete. As a matter of fact, we just did a deal for an advisor. It wasn't a Succession Link client, sorry, Phil, but he was with a captive bank, and we went in, we put the package together, and then we bid it out, and we saved the guy $87,000 in fees. And so when you're with a captive bank, you kind of get trapped. At the end of the closing process, they may come up with, they may not disclose all the fees, or they may not tell you all the intricacies of the closing, and you have to end up using them because you only have one option. So what we do is we package all the business in one package. We get a lot of information from Succession Link as a partnership. We then send that package out to our bankers and have them bid on your business, come back to you and say, okay, here are the 4 people that bid on the business. Here are the different rates, terms, and you'll be surprised when you make banks compete, you get a better deal. Now, most of the lending that we do is in the SBA business. Now, you have to realize there's also other banks that do non-SBA lending we help our advisors with. Term loans, tri-party loans. The good news is we have another 12 partners that we do non-SBA lending with. And so what we do is we go in and we provide a pre-qual for you after we get the package, so you get a good sense. You'll be able to go back to the seller and show them the pre-qual, and then you as the buyer get to pick the different banks the option you want to use. Again, it all goes back to our philosophy, Phil, that we're the advocate for the financial advisor, and I would never buy one mutual fund for all my clients, and that's all I would offer to them. You make the banks compete and fight for your business, and everyone seems to win that way.
Great. And as a follow-up to that, are you guys constantly vetting and looking for additional banks out there that are willing to finance and put money to work for practice acquisitions?
Yeah, absolutely. What's really interesting is that the banks are starting to wake up. I mean, it only took them 50 years to realize that the financial advisor, he or she, owns an incredibly valuable asset. Financial advisors are the 1% in our country, in the world. They are the 1%, and they have a business that is incredibly valuable. And banks have started to realize that there's no defaults. I can't say no. There's very rarely any defaults. I'm unaware of any defaults in all the business that we've done or I've seen done in other firms, because the bank lends on the combined cash flow and debt coverage of the combined business, and there's always going to be a buyer for a high quality business. So because there's no defaults, more and more banks want to get in our space. The problem, Phil, I saw this with he's a $10 million producer. I'm not going to give you his name, but he is a serial acquirer. So he lines up 4 or 5 deals right in a row, and he was spending, until he started working with advisor loans, he was spending almost a day a week, not him, but his team, trying to find different banks to do different loans for him. And it was a complete waste of everybody's time, because they'd have to redo the packages, they'd have to go and find different banks and different lenders. And so, we do that all turnkey in-house here. I'm in Golden, Colorado today, where our team is based. And so, yes, we're constantly adding banks. What we do is we educate these guys that cash flow-based businesses have value. And if they don't understand that, we pass on them. But if they do understand it, then it just becomes another choice for your clients at Succession Link, Phil.
Great. So could you talk a bit about just a quick overview, or as quick as it can be, I guess, on the SBA lending process?
Sure, absolutely. So I mentioned earlier, Doc Kennedy runs our tax regulatory division. And so when you go to advisorloans.com, you can see Doc and all of our leadership team and all of Doc's stuff. Helena Hauk, she runs our SBA division, and she has done over $150 million in loans to advisors via the SBA. The SBA so I'm just dangerous. I wish Helena was here. I know enough to be dangerous. So I would encourage you to do 2 things. Phil and team were kind enough to have our SBA, there's a 1-pager of the SBA process, but that's also on our website at advisorloans.com. And also our SBA deck talks about SBA lending in great detail, in addition to the fees and all the other stuff. So I would encourage you to go through that. But in a nutshell, there's 2 kind of basic types of lending through the SBA. The SBA is obviously a Small Business Administration. 7A is for working capital and acquisition capital. These are loans that can get funded fairly quickly. It is a government, so there's a lot of paperwork to be done, but that's 7A. You hear somebody talking about 504, that is real estate. So 504 real, that is when they will do financing for real estate. You want to buy a building, you want to redo your building, and it's a lot bigger dollar number. It is a much longer lead time to do SBA 504 real estate lending, just because of all the permits and all the other things dealing with real estate. But those are the 2 main types. And obviously the beauty of the SBA is they guarantee a portion of that loan against default. Now, of course, the government also will put a lien in your house, put a lien in your business. All banks will require a set-off of your life insurance. So if you take a loan for $500,000, they'll want either a new term policy, or they want you to designate a portion of your existing term policy to the bank in case you get hit by a bus to pay the loan off. So the government does guarantee it, but it does come at a fairly high guarantee price. We do a ton of SBA lending. And so what I'll say right now before I get into some limits on the SBA is if you're going through a proprietary SBA single bank right now, I want you to pick up the phone and call Helena Hauk, or I want you to go to Advisor Loans and talk to Michael Fritz, go to our website, because if you put together all of the information, all the package information about a practice you're going to buy, we'll get that package and we'll shop it for you and we'll see if we can get you a better rate. Even if we don't, I guarantee you that your current lender will lower their rate because they know there's competition. So if you happen to be going through a proprietary single bank on an SBA loan, go to advisorloans.com and get in touch with our team, and we'll work hard to bid for it. And again, we'll be your advocate. We don't win all of our deals. We win a lot of them. We want to make sure you're getting a good deal. I had a call with a COO of a company. They do $7 million in business. They're doing a $5 million loan. They went to a third party and had them package up everything, and they said they'd shop it to different banks. Well, they shopped it to one proprietary bank, and when the COO came back, she's like, where's the other banks? Well, this is the best deal you're going to get. And so we literally had a call with her 2 days ago, and that package is now in front of 10 different lenders. And we'll see if they get a better deal. But it gives them peace of mind they're getting some competition. So again, if you're working with a proprietary SBA bank right now and you got a deal, even if you've got a letter of intent or a pre-qual, we can certainly jump in immediately. There are some limits to the SBA. One of the growing trends that we're seeing, Phil, is partial acquisitions. So the SBA won't do partial acquisitions, but we're seeing a lot of advisors that want to sell a part of their book and join your team and see how it works. You know, do you take care of the client? Are you a good cultural fit? Do you have a compatible investment philosophy? Do you have a great service model that works for their clients? The SBA doesn't do partial acquisitions. We obviously do with our other non-SBA lenders, but that's a growing trend. The other thing that happens is the SBA does not want the seller to remain in the business for more than a year. And a lot of times people just want a sunset. They want to do 2 or 3 years. So we have lenders that don't worry about, well, if the advisor wants to stay around for a couple of years, that's great. I mean, the reality is if the advisor stays around longer than a year, client retention tends to be better anyway. You end up doing more business. And if the other firm has the ability to have a better service model, they may actually get greater share of wallet. There is a $5 million limit with the SBA in terms of utilization. You may laugh, that's a lot of money, but I got to tell you what, once you actually start doing acquisitions with Succession Link, you're going to find after you do your first one, you start prospecting and building your pipe. You can do 3 or 4 of these things a year, and you'll get to the $5 million limit pretty darn quick. And so a lot of times you don't have the ability to do more because of the cap or because you're going to need collateral for an SBA loan. So you may need to put 25% down, and you may be able to do that for the first acquisition. You may not be able to do it for the second, third, or fourth. So there's not any down payment there. So again, the SBA, we are very excited with our SBA partners. We've got a lot of great banks that really want to compete for Succession Link clients. But please go to the website advisorloans.com and check out the SBA guide as well as the SBA process map. It'll give you all, we've included everything in it. We're all about full disclosure. Fees, how it works, the information you need. I know my competitors are going in there and taking all our stuff, but that's okay. I want the advisors on the phone to be able to see everything. We're completely transparent, and we clearly are just we're the advocate for the advisor. But to close the loop on the SBA piece, if you are working with a proprietary SBA lender today, hit up our site, call Helena Hauk. Let's get some competition going. If you've got a lien that you're your head's hiding in the sand, let's get that fixed before your firm discovers it, or worse, FINRA discovers it. You don't want to deal with the fines or suspensions that could come from FINRA discovering it. And look, stuff happens. We helped out an FA recently who has a tax problem. And he has a tax problem because he had too good of a year. And what I mean by that is he had an incredible year. He didn't withhold enough from it. His calculations were off in terms of how much he had to withhold. And all of a sudden, he was holding the bag on a $127,000 payment he had to make in April. and it's all because he had an awesome year. Well, you know what? We helped him out with that. You can't use loans to pay off taxes, but you clearly can get capital for working capital and expansion capital. But if you're getting in trouble, let's be careful and work with Doc's team or work with Helena. So sorry, Phil, that was a little long-winded on SBA, but I wanted to make sure I covered enough for you.
No, it certainly helps. One follow-up question to all of that. How many of the loans, or at least inquiries that you have coming in, are going towards working capital versus flat-out acquisitions?
Yeah, you know what? It's about 60-40. 60% acquisition, 40% working capital. And that working capital, Phil, tends to be in different types of working capital. Most of our lenders want to have the loan to be at least $250 or above, but a lot of times you just may need some capital to buy new computers, buy office equipment, buy furniture, blow out a wall and expand a space. And so we do have lenders that, you know, call it 75 to 150 that can do working capital loans. The SBA also has express lending that we do a decent amount with. That's a smaller number, and it's express. I mean, it'd make your head scratch why they call it express, because you still got to provide a lot of information, but it clearly is available for that. So probably 40% of everything we're doing is on the working capital, investment in the business, investment in growth and marketing, and then 60% is for actual acquisition. And then again, the big trend we're seeing, Phil, is partial acquisitions, where you buy a piece of the book versus the whole book. And we've actually had an FA we're working with now that came through your site, that he's got a $150 million book. He's actually he wants to break the book up into 4 different tranches. He's going to keep one tranche, and you can sell off 3 other tranches, because he doesn't feel like that his clients will be taken care of, or the service model will be good if somebody came out outright bought the whole thing. So 60-40, Phil, 60 for acquisitions, 40 for working capital.
Great. And we had one interesting question that came in through the registration process, specific to an advisor situation where they're 2 years into a buyout / earnout, and they're curious about getting financing at this stage of the game. So I guess if you can answer the question of, you know, if there is an advisor that is at any point in an earnout or a buyout, is there financing options available for them to complete that? And what does that look like?
That is an awesome question. So before lending to financial advisors and practice acquisitions happened, and before like advisor loans came along to add some competitions, the single prop lenders, when you sold your business to another financial advisor, you typically got, call it 25% up front, maybe a little more, but then you had to hope that the check in year 2, 3, and 4 didn't bounce. And that's a scary, scary thing. Hope is not a strategy. Hope is not a strategy. And so if you have sold your business and you've got an earnout or a buyout that's still out there, our lenders are very willing to come in and step in and take that obligation, so that the seller will get the rest of their money completely paid off. You know, again, assuming that 80% of the assets paid, which is the typical covenant that most sales agreements have, and then the buyer then only deals with the bank, doesn't have to deal with the seller any longer, and doesn't have to deal with potentially payout reductions, or or dealing with issues that may come up over the course of a 2, 3, or 4 year time period. The other thing that you really want to make sure happens is, if a seller is going to leave the business, you want to make sure their licenses expire and they don't compete against you. And obviously there's non-competes in these deals. But so the answer to the question, Phil, the answer is yes, absolutely. We do have banks that would like to jump in and fulfill debt that is owed over the next 2, 3, 4, 5 years. And quite frankly, you could then take that and spread it out over 5 or 7 years, and then potentially do another acquisition with Succession Link, and have a better cash flow situation. The other thing to think about is we also see advisors that leave the wirehouses that have prom notes owed and they need working capital to start up their own independent or RIA. And there are firms out there that will lend, if there if from a working capital perspective, provide working capital for the business and to potentially pay off a prom note that you owe at a lower rate than what you've negotiated with your losing firm. So that is actually a really, really good question, Phil. If advisors out there have purchased a practice and they're doing private financing, or in one case I saw a $5 million producer who was paying 10 points to a bank, which is insane on a practice. If you're paying high interest rates or you're self-financing, we'd be happy to jump in and help in that process.
Great. And I know one final question that we have here before we get to the end. I think we may have touched on this earlier in the presentation, but we'll ask it direct here. How many lenders offer financing for these acquisitions? I know that you mentioned that you guys are working with roughly about 16 banks, but do you know how large that universe is beyond those 16?
Right, it's a great question. So we've got 12 SBA lenders, 12 to 14. We've got 12 that are active with us, and we got 2 more we just signed up. So we've got 14, call it SBA lenders, and we've got another, call it 16 non-SBA lenders. The issue with banking, Phil, is that they don't understand our business. They don't understand cash flow-based business. And so we have a gentleman on staff named John Steele who actually vets new banks to lend to financial advisors. So I don't know the actual answer to that question. We're very happy with our lenders because what's happening is we're ending up getting a series of lenders that like to do West Coast loans, a series of lenders that do national loans, a series of lenders that like East Coast loans. We've got 4 lenders that only want to do $5 million and above, which is at the high end, obviously. We have probably half of our lenders want to stick in the $300,000 to $700,000 range. So the beauty of having so many different lenders is that when an advisor comes in and says, "Hey, I only need $100,000 to buy furniture and fixtures and new computers," we know where to go. If an advisor has a $5 million deal, we know where to go. If the advisor is in Texas, we've got 2 banks that want to do all you can eat in Texas. And if the advisor's on the West Coast, we have banks that only want to do West Coast, and same thing with the East Coast. It is kind of interesting. The East Coast banks only want to do East Coast lending. You know, they like dealing with the East Coast type FA, and the West Coast banks don't like dealing with the East Coast type FA. So don't know the right number, Phil, but we're adding. I wouldn't say weekly, but we're adding on a monthly basis once we vet them out and just make sure they actually have the capital. We don't really deal with any mom and pops. We want to make sure that all of our lenders have the ability to step up, you know, to do at least $20 million for Succession Link clients.
Perfect. Well, that will bring us to time. So, John, I certainly want to thank you. We appreciate your time here today, and certainly the continued partnership that we have with Advisor Loans. And all of our conversations are always insightful, so I hope that everybody on the line has a lot of good takeaways. I know, personally speaking, that anytime advisors from Succession Link work with you and the team, they always have great things to say. So, again, thanks.
Well, thank you, Phil. Thank you for having us. We are so excited to work with Succession Link FAs. You are the hottest dot in the industry, and I would tell everyone that's on the line that hasn't registered to register with Succession Link. It is an awesome service. The emails I get daily about the new practices that you guys list are crazy. It makes you kind of want to go back into practice and just pick off practices for sale on Succession Link. Our partnership, obviously, at Advisor Loans, we want to finance every deal that you have, and we're committed first and foremost to being the FA's advocate. We're committed to Succession Link, and so I look forward to doing a follow-up call, Phil, down the road, and I just appreciate you giving us the time. And everybody hit advisorloans.com, and we're looking. We've got a lot of capital to lend out, so I appreciate the opportunity.
Absolutely. Thanks, John. for our audience, that will conclude today's webinar. If you have any questions that are specific about your situation that perhaps we didn't address here on the call, please feel free to reach out to Succession Link support. If it's something specific about practice acquisition financing, John Pierce's information is available on the slide right now, and I know his team would certainly be happy to help. So thanks again, everybody, for joining, and have a great day.